We are getting a lot of requests for this. We're doing a deeper dive on Walgreens today. Stock ticker symbol is WBA. The goal will be to go through the 10K, go look at some people's opinions on the pros and cons of WBA Walgreens. Guys, the important part here is we use our 8-pillar process to look at a company from a quantitative perspective. We're going to do that right now first, and then it's going to kind of tell us what are the things we want to look at in the 10K and from other people's ideas. Remember, we have this community here of thousands of people that are talking every day, and they can talk about Walgreens. But we're going to go look at the aspects of the company based on the facts we see and then some people's opinions on their side. So let's start. Let's pull up our software. Let's pull up WBA Walgreens. Walgreens Boots Alliance. All right, the stock is currently at $36 a share. So we pull up Walgreens, and guys, Mo's on this because Mo did a deep dive. What was the stock you did a deep dive on? Intel?
Yep.
Great. So we're going to do these deep dives a little more regularly. I mean, I don't know how regularly, but we're going to start doing them. So let's pull up Walgreens, WBA. So first from this standpoint, one thing I want to point out, look at this dividend yield, 5.4%, pays out $1.7 billion. That's less than half of their free cash flow last year and way less than half of their 5 years. So I like that. As an example, American Eagle today just announced they're pulling back their dividend. And I wanted to go see, I'm like, okay, let me go see if American Eagle, if I would have wondered about their dividend. So I look at American Eagle Outfitters, and their dividend was 7%, $121 million. Last 5-year average was 140. Last year was negative 60. Made perfect sense to me. Mm-hmm. And if I'd been looking at the stock before, I probably would have thought to myself, I'm a little questionable on that dividend, but either way. So back to Walgreens.
Nice thing. Walgreens just put their dividend there. They did an increase, and
they just did one?
They just did one, yeah. And their shares, they're still buying them back. So this is great on all fronts.
Okay.
Yeah.
Gross margin 22%, 5-year profit margin 2.7. Last year's profit margin 4%. So considerably 50% higher profit margin last year than they've had in the last 5 years. But let's go check out why. Because it could be that the last 5 years they had some ongoing expenses. So let's go look at them. Oh, look at this. Their net income, 4.3, 4.8, 760, 2.3, 5.4. So 2 years of a big drop here. Okay. So it looks like their profit margin overall should be 3 or 4%, right? So that's great. Pretty stable. As Mo said, buying back shares, they were at 1.08 billion down to 864. Let's go look at their 8 pillars. All right, so long-term liabilities high. Guys, I'm willing to bet a lot of money. This has to do with the leases of the company because that's added to long-term debt in most cases. So that's understandable because Walgreens is going to make their money off their locations. It's very primo locations. They have had a drop in free cash flow, even with revenue growth and net income growth. Not a high return on invested capital, so I'm kind of wondering about that. But very low PE, 5-year, very low price to free cash flow in the last 5 years. So, okay, this is...
So talking about the debt and that ROIC, I'm just looking at CVS to compare them, and they're a similar situation.
Are they?
Yeah, so I'm wondering if that's just the industry.
Okay, so I'm going to the metrics page. If you guys know our software, on the metrics page, we have this button down below called Annual Reports. If you click on it, it's going to take you right to the SEC website. You click on the 10K here, and then go right down here to the 10K amendment. Nope, we don't want to go to the amendment. We want to go to the actual 10K from before. It's much longer. All right, so what's the 10K? The 10K is their annual report where they get into a lot more details. They put footnotes in there. They explain a lot of things. The things I'm going to look for in this 10K. When it comes to retail, I want to look at same-store sales. What are their comparable and same-store sales? Stores that have been open 12 or 18 months, and they'll define it in the 10K. They'll sit there and say, hey, we define comparable store sales as this, and we're going to show it. They're going to show how many stores they're opening, how many they're closing, etc. Mo, is there anything else you want to talk about before I start looking into that?
No, I think that's a good way to go right now.
Okay, so why don't you start looking at some of the questions you might be asking while I look at the 10K.
Okay, so something I like to do, as you guys saw in the Intel video, is I like to go and start looking at, I know Paul's going to bring this up, but go and start looking at some bull and bear cases. We can be swayed. We've looked at this. The numbers make sense to us. So now I'm saying, okay, now I need to go, let me go look at a bearish case of somebody that's against Walgreens, or another bullish case to say, hey, am I hitting on all the right things? Are the same store sales right? Are they wrong? Is it a good direction to start going? And so go ahead, Paul. Do you have same stores over there?
Oh, you want me to go through this?
Yeah, go through that first, and then we'll do this.
So I pull up their 10K, and it's going to show their same store sales increase and decrease across the last 3 years. So comparable store sales, 2019 were up 2%, 2020, 2.8%, and 2021, 5.1%. Okay, so we're still seeing that stores that are being opened, that have been around for a while, and stores that are existed are getting increases in sales. Because remember, it's possible for a retail company to have increasing sales, but if all comparable store sales keep decreasing, it's not the same story. It shows that, hey, we're opening sales, but our sales are still decreasing. That's not good. Retail sales were actually down though, 0.4% the last 2 years, but comparable pharmacy sales, look at that, 6.7% last year. Comparable retail sales are actually up 1.2% and 1.6%. So that's kind of some interesting things.
And I'm looking here at their quarterly report that they put out.
Yeah.
U.S. retail comparable sales grew 2.4%, excluding tobacco.
Oh.
That's good too. So that's a good thing to know. They're excluding that.
I didn't even know they sold cigarettes. They sell cigarettes at Walgreens, did they?
It's actually kind of a funny thing that they do.
Yeah, that is kind of funny. All right, gross margin. Gross margin is staying pretty steady. Last 3 years, 22.6, 20.7, 21.2. And they're selling SG&A expenses. Selling, general, and administrative expenses are about there. All right, so overall, we're seeing a very consistent company. We want to look at their margins. We want to look at their same store sales for retail. We want to get a feel for this. And nothing here is glaring at me and going, ugh. I mean, this is a big company. This is a company that last year in the last 12 months, has done $135 billion in sales. It's going to be very, very difficult to sway the meter up or down. Now, the great thing about Walgreens is it's the corner store that you go to very quickly. Go ahead, Mo.
Listen to this number. Boots, so that's in the UK, it grew, comp sales were 24% gain.
Oh, wow.
Yeah, with market share gains across all categories.
Wow.
So they're doing very well.
And what percentage of the revenue was from the European?
I haven't pulled that out yet. I can pull that up though.
Look what I just did there. Mo showed a 24% increase. And I want to be like, hey, what percentage of their sales comes from that? Because if it's $1 billion and they're going 20%, that's only $200 million to the $135 billion income level, revenue level. So I think like a business person in the sense of, since I have 8 or 9 business upstairs, I'm always going to be asking, I think this is what makes me a pretty decent investor. I'm going to ask the questions of, okay, if I want to buy this business as a whole, how would I do it? That is why I understand value investing. So if you're new to this channel, Mo and I are value investors. Our goal is to look at our 8-pillar process and look at the numbers of a company and decide if we go further or not. The numbers will tell us a story. If the numbers tell us a story that we like, we're going to go dig deeper. This is part of that deeper dig, okay? We're going to sit there and we're going to try to find a situation where the market's perception of the company does not equate its value. We want the price to be lower than the value of the company. If we find that in a company we like, we buy the shares. That's not something that's done overnight, but it doesn't take a year to research the company. You should be able to do it with a few hours of research. Once you've already sat there and said, I kind of like this company. And when we looked at our 8 pillars on Walgreens, we liked the company. All right. Mo, what are you finding over there? Anything?
So it's about,
what was that?
Let's see here. 15%, 20%.
Okay.
So
about 15 or 20% of their revenue comes from Europe.
Yeah.
And they were able to grow that 25%. That alone is a 3%. So
that's great.
Then it tells me, wait a second, are US sales falling then?
That's a good question.
Because look at it this way, guys. If you have $100 in sales and 20% of your revenue grew 24%, that means you grew 4.8% of your overall revenue, 24% times 20%. So if they had 4.8% there, it looks like US sales probably aren't up that much. And that's something we can look at. And those are the things that immediately hit me going, all right, is there an issue in US sales? I don't know. So let's go look at locations. So I'm going to go to the 10K, which I'm in right now. And I'm going to say, let's see here. So I hit the word open and I'm going to try to find, they actually, right here, really quick. Comparable sales are defined as sales from stores that have been open for at least 12 consecutive months without closure for 7 or more consecutive days. That's how they gauge same store sales. Okay, now I'm going to look for open. How many stores were opened? Let's see. I'm not finding it. So closed. Okay, store optimization program. On October 24, 2017, the board of directors approved a plan to implement a program to optimize store locations through the planned closure of approximately 600 stores and related assets. Upon completion of the acquisition of certain stores from Rite Aid, the company closed 769 stores and related assets. Okay, that's from that. Man, so I'm not seeing actual locations, number of locations here, guys.
Okay.
Go ahead, Mo.
8,000. This is a breakdown of their retail stores. So in the United States, they have 8,860.
Where are you seeing that?
This is in the 10K.
Okay.
Puerto Rico, 104. Virgin Islands, 1.
Oh, right here. Gotcha.
UK is 2,276. Mexico, 1,110.
Okay. So right here, the total. But we want to see how many overall. So that's something to look into because I really want to understand, are they opening, closing overall? Now, my guess is...
Like a net?
My guess is these, Mexico's got a lot. They got about 10, 11%, 9% of their overall stores. Okay, so it's not... where's the growth going to come from? So the good news is you're going to really rely on organic growth. And I wonder if there's anything about organic growth here. Nope, nothing about organic growth. Okay, so organic growth is basically how much are they growing internally without the same store sales. And overall, it's basically a longer term same store sales. So Mo, why don't you check out the bear case on Walgreens while I do a little bit more looking at the numbers here from our 8-pillar analysis. Okay. So look at our analyst guys. So we have analyst estimates on our website. We go out 5 years here. Now here, remember, there's only 20 analysts. This is what we pull from our data provider. There are way more analysts than just 20, and analysts will have different expectations. But if you look right here, there is not growth in EPS. They're basically down about 5% over the next 5 years total. Not great, but look at their revenue. That's the interesting part. The revenue is up about 10% in the next 5 years, according to analyst estimations. So you sit there and say, okay, revenue's gonna be up, but profit's gonna be down. Don't like that too much, even with buying back shares. So that's interesting here. Let's see if there's any news on Walgreens. So if the company's growth potential is not there, they're gonna give value to investors two ways. They're gonna pay a dividend, which they're paying a very healthy dividend, and they're gonna buy back shares. But the key on buying back shares, guys, is we wanna make sure they're buying back shares at a cheap price. Now, if you look at our 8-pillar analysis, this 5-year price of free cash flow and 5-year PE says it's cheap, okay? So what they're doing when you buy back shares, for those of you who are new here, if you have a company with 10 shares outstanding and you own one out of 10 shares, you own 10% of the business. If they buy back 2 shares, now the company has 8 shares outstanding, but you still have your 1 share. Now you own 1 out of 8 shares or 12.5% of the business. That is the key to buying back shares, but we don't want them buying expensive shares back. Why? Because when they take the cash and buy their own shares back, they're investing. Doesn't matter if they're investing in themselves or another company, they're still investing. So if they buy expensive shares back, they are buying overpriced shares of a company, whether it's themselves or not. But when they're buying back shares that have, here's the thing for Walgreens, when they buy back shares, they don't have to pay that dividend on those shares anymore. So they're saving 5.4% yield on those shares, and they're buying back ratios of free cash flow and earnings that are very, very low. So I'm actually surprised their buyback is not speeding up. So I'm going to look at their 10K to see that. Mo, why don't you go ahead?
So this is something that I've seen in a lot of places, and this article from Seeking Alpha condensed it pretty well. Rising labor costs. This is something that is not only in this space, but it's also looking at in the CVS. So it's in the whole this whole pharmacy area. Reimbursement pressures from insurers. Again, they're a pharmacy. They make a lot of money from drugs here, and people get their drugs from Walgreens. The issue is it ties into healthcare. What's the situation going to be with healthcare? So that is a bear argument against them. Stale retail assortment. I don't know if I necessarily believe this one. You go to Walgreens for everything. It's a great one-stop shop. So people are worried about those kind of things going forward, but I also look at them and say they're starting to do these hubs where they're going to be the almost one-stop shop for your primary care, your mental health. I'm starting to see these around, so that alone might start drawing people into their stores without having to necessarily worry about this stale retail assortment. That's kind of like what Kohl's did. They pulled in Amazon just to get people in their stores. It's just a different way of going about it. But as far as the reimbursement from insurers, that's been going on for such a long time. I don't necessarily think that that's going to be a major issue. Rising labor costs. Everyone's facing that. Everybody's
going to face rising labor costs. When I hear things that are applied to everybody, I just immediately say, okay, well, it's everybody.
That's when I see. That's why when I started to look through these bearish cases, I was like, how much validity is there? Also, just a side note, this author, go and look at other things he wrote on other companies, even if you're not interested. See if he's always if he's bearish on everything. If he just hates it all, or if he just loves it all. Just make sure you know what's going on with the author.
Yeah, that's a very important thing to do when you're looking at somebody's opinion. Make sure the opinion is based on some sort of facts that really matter. I can't even say it. Because you don't want to sit there and, like, for example, EV is the future. That's why I'm buying this company. Well, I get it. EV is the future, but it doesn't mean you go buy the company. So right here, their share repurchase plan. In June of 2018, Walgreens authorized a stock repurchase program which authorized the repurchase up to 10 billion shares. So here's what they've done from June to August of 2021. Big fat zero. Because they said in July 2020, the company announced that it had suspended activities under this program. So I'd want to go back and find out why they suspended that activity. Because I'm looking at the cheap shares going, why aren't they buying these back? Why? But they increased their dividend, yet they're not buying back shares. It's a very tax inefficient way to give money back to investors.
Yeah.
So let's go look at their return on invested capital. So a lot of companies, oh, wow, they're not even putting it on here. Oh, interesting. So they're not even putting, so that's a concern of mine. Why are they not disclosing their return on invested capital? Now, there are multiple ways to calculate return on invested capital. Our method is we look at the equity and the total long-term liabilities and compare the free cash flow for it. And we look over a 5-year period. So what's important about the return on invested capital? Well, what it is we want to make sure the return on invested capital is larger than the weighted average cost of capital. Weighted average cost of capital is you look at their debt and their equity, and you assign a certain return the investors want for debt, for equity, and what they're paying on their debt. And it's an average. So let's say, for example, it's 50-50 debt and equity. And the equity investors want a 10% return, and the debt investors want a 6% return. Well, 10 plus 6 is 16 divided by 2. The average is 8%. So in order to find a company that's generating wealth for the business and doing a good job, you want this to be above that 8%. Now, it just depends on where the company is. So right now, we go to the balance sheet. Debt is $62 billion. Oh, sorry, you have to sit there and I think it's based on long-term liabilities. It's $37 billion. Equity is $26 billion. So it's more debt than equity. And you would apply these rates. So let's say it's 10%. So on the debt portion, guys, so the long-term liabilities here, the long-term liabilities are $37.5 billion. The shareholders' equity is 26.25, right? So what we want to do is figure out what's the overall cost on that based on just some generic idea. Now, obviously, their debt is going to be contingent on what they actually pay. But let's say overall for average, it'd be 6%. So 37.5 plus 26.25. That's $64 billion. So let's say they need 0.1 times 37.5 plus, 0.06, 6% times their debt of 37.5 plus 10% on 26.25, 4.875 divided by that 64. So they're basically their weighted average cost of capital and I'm doing a very high level is 7.6%. And their ROIC was 7.3%. So technically, they're not getting a return on their invested capital high enough to satisfy. So they're not really creating wealth here. So maybe it is a good idea. And for companies like that, you want to pay a lower valuation for the company. Mo, go ahead.
Do you look at that? This is a question for you. I look at ROIC and say, this is a way that I can kind of look and see how management is going about this company. Like when I look at a company, they have very high ROIC. For somebody like Walgreens, I can't call investor relations and get any useful information. Sleep Number or something like that I can. This number tells me how management is.
So I think if you read the book, the little book that beats the market, ROA and ROIC, that's how Joel Greenblatt basically says top quality companies. Mm-hmm. If you can reinvest the capital, high rate of returns, it's a top quality company, right? Because now you're able to grow the company. And even Charlie Munger says that over a long period of time, that the ROIC is, even if you overpay, should be about the return you get for a company. Now, I think Gary, as an example, kind of argues that, and I do get that. But basically, on a low ROIC business, you want to get them really cheap because they're not going to invest the money at high rates to compound. Right. And you're going to want to get a lot of money in your hand as fast as possible through a high dividend. Yeah. That could be the case here.
Okay.
All right. So now the thing about Walgreens is like, if they're only getting 7.3%, like look at a real estate deal. Mo, because you've invested in some of our real estate deals. Yep. If every dollar of cash flow we got in, we reinvested at 5%, you'd be like, that sucks, Paul. Just give me the cash. I'll go invest it at 15%.
Right.
Why are you investing it in the deal, back in the deal at 5%?
Right.
That's not even covering our interest costs. So that's kind of the idea there. Okay. And that would tell me that management sucks.
Yeah, coupled with the share buyback and everything that they're doing. Yep.
Right. So let's go to talk about their competition, Mo, and then I'll do stock analyzer.
Yeah, one important thing I think we need to point out is the Amazons of the world, Walmart's, Mark Cuban's pharmacy, et cetera. Those alone, and the Mark Cuban pharmacy is legit. My dad is.
Wait, you're serious?
My dad is using it nonstop, and he is like, this is a fantastic company. So they're still small. We'll see how that is when they grow. But these, I think that bearish case that I was reading about, that's what they should have put in there. Things about Cuban pharmacy, Amazon, Walmart, et
What's
cetera.
Cuban's pharmacy even called? I thought it was a joke.
Cost Plus by Mark Cuban or something. Yeah.
All right.
Sick.
All right, let's go.
I order drugs from him. It's great.
Have you?
They're cheap.
All right, let's go to our stock analyzer tool. So guys, I'm going to use that ROIC number to affect my PE and price of free cash flow and desired return. So revenue growth. According to the analyst, revenue growth is not going to be there. So I'm going to go with -2 to be conservative, 0 and 2%. Profit margin. I'm going to go with 2.75, 3, and 3.25. Now, the reason I didn't go to 4, it was only 1 year of 4%. So I'm not going to focus on that. Now, granted, with that said, I know in the last 5 years, they had a lot of write-offs because of acquisitions and some other expenses. So I'm still going to put in, even though it's a low number, I'm still going to keep it in there to be conservative. Free cash flow margin, I'm going to do 3, 3.25, and no, 3, 3.5, and 4. PE, I'm going to go 8, 11, 14. Nope, 8, 10, and 12. 8, 10, and 12. Now, why is that? Guys, I have very low growth numbers, and I have a low return on invested capital compared to the weighted average cost of capital. So this company needs to get me more money in my pocket and maybe buy more shares. I don't want them to go expand. That is a concern. So I want to make sure I pay a little premium because they're not exactly making a ton of wealth for my investors. And finally, for desired annual return, I'm going to do 12.5, 15, and 17.5. And here's the reason why. This is probably not very likely. This means the revenue would fall about 20% in the next 10 years. Probably not likely for a company like Walgreens. 0, all right. It's pretty stagnant for the next few years where that continues, and 2% at the high side. And I'm also, the worse my assumptions are, the lower return I need because I'm already beating the thing up. The higher my assumptions are, the higher the return I need because I'm probably being more aggressive. Now, I'm going to hit the analyze button. I very much encourage you to rewatch the parts of this video you want to understand. We literally did this the way we do our other investing. We just literally go through it like this and we decide, okay, should we do more? There's going to be 6 numbers here. 3 based on earnings, 3 based on free cash flow. If they're all green, it doesn't mean go out and buy. It means go verify this information is correct. Go do that work that we just did. But most importantly, guys, join our community. It's less than a cup of coffee per day. You get all this software, you get the chat, you get everything, but you get thousands of people in here wanting to talk about investing. And one of the things we've done well is we've really helped people avoid the hype stocks and then the big falls that occur for them. Go look at our past videos when we talked about Workhorse, Peloton, Palantir, when everybody was hyping them, calling us stupid for ignoring them, and Neo and all these other Nikola, and we said avoid them, and they all collapsed. That is worth just as much, if not more, than getting the big returns. If you just avoid the big collapses and match the market, you're going to have less risk and a better life. So less than a cup of coffee per day. Hit the analyze button and boom. All right. It's 3 of them are green, 3 of them are red. So we're pretty close. Add it to your watch list at whatever price you want. I'm going to put it in at $33. Guys, that's our analysis of Walgreens. If you like this and you want to see another analysis of Intel, please click the link above and please subscribe to our channel. Thanks, Mo.